Hey, I'm Tomer. We are going to cover and break down the entire venture investment process for your startup. How to pitch, what investors are really looking for, term sheets, due diligence, and how final negotiations and milestones work. Whether you're fundraising for your first round or preparing for growth stage investors, I will give you a practical roadmap. First, ask why you're raising. Growth, product market fit acceleration, hiring key people. The reason shapes everything: who you talk to, the amount you ask for, and the terms you accept. Raising too early, or for the wrong reasons, creates more problems than it solves. The pitch isn't a pretty deck. It's a story with clear milestones. Investors want to know problem, solution, market fit, unit economics, team, and how you'll use the money. Keep early outreach crisp: short email, one-line intro, and a deck attached only when asked. Personalize. Be respectful of time. You'll pitch different investor types: angels, seed funds, VCs, corporate VCs, and each meeting is different. We talk about this in up-and-coming videos. Be sure to subscribe for later videos. Always know who will be in the meeting and what decision they control. Remember, there is nothing wrong with being bootstrapped. Venture capital should not be the destination. When an investor wants to invest, you get a term sheet. It's non-binding, but sets the deal structure. Items include valuation, liquidation preference, milestones, etc. Term sheets is something I'll cover in a later video. Pre-money versus post-money valuation. Know the difference. If an investor says, "I want 2/5 of the post and I'll put up X," translate that into percentages and dilution scenarios. Due diligence is where the promise meets paperwork. Expect legal, financial, commercial, technical, and sometimes customer checks. Investors want to confirm your claims, traction numbers, IP ownership, team backgrounds, etc. Be organized. A shared data room speeds things up. After due diligence, you negotiate final terms. Be realistic. Negotiating every clause can slow the process. Focus on the big ticket items that affect control and dilution. Valuation affects both ownership and future rounds. Understand pre- and post-money math and how an option pool impacts your dilution. A practical experiment for you. Speak to a startup company. Meet the founder who has raised capital. Ask them how long it took to raise, how many investors they met, valuation changes, and what they gained from investors. Consider these type of questions: how long to close rounds, number of investor meetings, valuation progression. Investor value beyond money. Would they raise again? What investors look for in follow-on rounds? Where to find capital? Friends, family, and fools. I'll go into this later. Angels, VCs, corporate VC, venture debt, accelerators, crowdfunding, grants. Each has pros and cons. A highlight of the benefits. Bootstrapping, control, no dilution, limited scale. Grants, non-dilutive, long process, lots of paperwork. Accelerators, mentorship and network, not guaranteed funding. Crowdfunding, community validation. You will need strong marketing. Venture debt, less dilution, interest and warrants. VCs, big capital and network, milestones and control. That was a mouthful. Here are my investor tips, so take some notes. Do attend events and meet face-to-face with investors. Do leverage warm intros. Network first. Don't spam cold LinkedIn messages without context. Do offer help or value before you ask. Try and help founders, investors. Start preparing now. Fundraising takes time. Recommended reading coming soon. Raising is part art, part process. Prepare your story, build relationships, and treat diligence as your chance to prove you can execute. Follow the link in the description to receive your free checklist. Drop a comment below and subscribe for more deep dives.